There is but one phrase that'll sum up the vast majority of 2023 when it comes to your favorite dividend stocks and even your favorite growth stocks, and that is cost-cutting measures. Man, I have never heard that phrase used so much except in these recent earnings reports. As we dive into three dividend stocks, we're going to talk about Verizon, Coca-Cola. We're going to be talking about 3M. Are the dividends sustainable? Is this the bottom of their stock prices? And is this presenting a buying opportunity of a lifetime? Well, I'm going to reveal that to you here. So consider hitting that like button. Consider subscribing for more earnings because we got a lot going on this week, baby. It's a pretty pivotal week as tonight we're getting Microsoft, Alphabet, the big tech companies that will truly move the S&P 500. But today is for you special dividend lovers out there. First and foremost, let's talk about Verizon stock, which right now is yielding 7.8%. My God, these yields are absolutely insane. It did jump up pretty dramatically in the last day on those earnings. It's up 8.5%, and this could be showing signs of a bottom here because people were pretty happy with this earnings report. And just getting into it, the company ended the quarter with approximately 10.3 million broadband subscribers, an increase of nearly 21% year over year. And year-to-date cash flow from operations increased approximately 600 million year over year, and basically year-to-date free cash flow increased 2.2 billion year over year. So they're definitely getting into a place of more stability, considering they haven't seen any real revenue growth at this point. The entire business has been relatively flatlining. We're going to take a look because you can see, just to kind of cut the fluff out, total operating revenue has done basically F all year over year. Their total EPS has basically done F all, except pretty much flatline toward the downside, but not too badly. But what's most intriguing to me and where this company is getting some oomph is how they're managing their assets and liabilities, because we can see that they've pretty much increased their total assets to 384 billion versus 379 billion, and at the same time decreasing their total liabilities, right? Because you can see that if you take a look at total long-term liabilities, they're down to 230 billion from 237 billion. So this is what we want to see in a tougher market environment. But taking a look just to give you a clear view of their revenues, pretty much for the last few quarters, they have been basically, again, there's nothing going on here from a revenue standpoint. It's basically just been decreasing for the last couple quarters. All in all, in a year over year, there's just, it's a boring big conglomerate. You're buying it probably for cash flow. That's why most people are intrigued. Your earnings are going to come out of the dividends. We can see EPS hasn't done that much either, but it depends on what you want out of this company. But we can see the dividends basically 10 years ago, well, 20 years ago, you'd be getting 35 cents. Today, you'd be getting 67 cents. Over a decade, there's hardly been any substantial dividend increases from 44 cents to 67. So from a dividend standpoint, these are companies that most people would probably be looking at just to lock in the yield. Is it reliable? Well, according to Yahoo Finance, which I never recommend trusting because there's amortization, depreciation costs, but the current payout ratio, according to Yahoo's 52.2%, which is pretty reasonable for the dividend yield you're getting. The giant that has stable, again, we're talking about telecom giants where they tend to get monthly cash flow. The revenues and their EPS don't tend to fluctuate as dramatically as other companies. So yeah, Verizon seems very intriguing here at a 6 times price to earnings multiple. People have really given up on it. I think there's some good value there. You look at something like Coca-Cola, which I think is more of a favorable company today than even the likes of Pepsi based off what I've seen so far. The stock only jumped up about 2% after earnings, paying a 3.3% dividend yield, has been declining from the recent highs. I mean, it's down about 15%. At the bottom there, it was down almost 20%. This one's been very boring, more of a Warren Buffett kind of stock, obviously. And honestly, if you're looking for cash flow, I don't think this one's the worst idea either. As Coca-Cola beats earnings estimate, raises outlook as volume grows despite price hikes. Coca-Cola tapped Wall Street's estimates for its third quarter earnings and revenue. And this, again, volume's increasing. They've been able to increase prices. Unlike Pepsi, that's seeing a bit of a drying up in certain volume. Because again, I think the product variance here is kind of intriguing just to see how they clash. But still, gross profit, you take a look at this, 21 billion versus 19 billion this time last year. You take a look at net operating revenue from 32 billion to 34.9. This is kind of what we want to see in a company. Take a look at assets, about 97.5 billion. You got total liabilities here. For current liabilities, we're sitting at about 24.4 billion. So they do got quite a bit of current liabilities, about 14 billion in cash, help cover some of that. The balance sheet's pretty healthy here all in all because assets are increasing pretty dramatically, which is great to see, but so as their total current liabilities have gone up. Actually, we can see long-term debt went down, which was nice. Deferred income tax liabilities went up a bit. So they're kind of balancing themselves out here from the balance sheet perspective. From a revenue standpoint, Coca-Cola has been all over the place. Really, this is a company that kind of reminds me of McDonald's. Like McDonald's, you're not seeing like a crazy amount of revenue growth, but what you are seeing is over the last few years, a nice recovery in revenue along with EPS, which they've been able to sustain very well through the fluctuations in their revenue. But still, all in all, taking a look at that payout ratio, guys, we can see 74.69% payout. It's a little bit on the upper end, but we're talking about a fairly stable company here that has a long track record and is still proving to do very resiliently in this tougher market environment. From the dividend standpoint, 28 28 cents 10 years ago. Today you're getting about 46 cents. So from 28 to 46, we're not talking about a doubling, but it seems definitely better than Verizon, but we're not talking about the craziest starting yield. I think there are better dividend growth stocks than Coca-Cola. Coca-Cola is kind of like that mid-range kind of company. It's not like the most explosive dividend growth. It's not the highest yield. It's kind of like just a typical boring brand kind of stock. There's nothing exciting about it. There's nothing definitely underwhelming about it. It seems like more of one of those just stabilizers you could put in your portfolio. And taking a look at 3M here, 3M has been piquing a lot of investors' intrigue here because they've been paying a lot out to lawsuits. I think they were dealing with like earplugs for the Army that actually didn't work and all kinds of other lawsuits. This company is jumping up on earnings though, and it has been a pivotal 5-year decline for this company, now yielding 6.7%. Getting right into this, 3M raises the full year profit forecast aided by cost cuts and price hikes. Sounds very similar to Coca-Cola, man. Just keep increasing the prices, baby. That seems to be what's driving a lot of the sales. But we can see their net sales, again, year over year for the 3 month from 8.6 billion to 8.3 billion is relatively flat. Again, we're not talking about any growth here on the 9 month. Again, relatively flat to the downside. Nothing crazy. Taking a look at their total assets, 49 billion, didn't really increase year over year. If we take a look at the basic total liabilities at 44.8 billion, definitely increased year over year. Nothing about this company's balance sheet is that intriguing to me. Again, revenue's been declining pretty much for the last, 5 consecutive quarters. There's not a lot going on that I think is overly exciting. People are looking at that yield and thinking this is the greatest thing ever, but 3M needs a real turnaround. Their dividend went from 64 cents to $1.50, so it definitely had some of the biggest dividend increases, but I think that's going to tamper out until the company gets, more of their financials and lawsuits under control. So of the 3 mega here, I think Coca-Cola is probably your bread and butter. It's one of my favorite, but Verizon's definitely doing really well here. It looks like they could be on a bit of a turnaround. I wouldn't be surprised if their stock finds a bottom at this point, but we won't really know until interest rates have peaked and these companies can finally start taking some of that debt payment, put it to the bottom line. But we're heading into the eye of the storm, and this is where these stocks look very fascinating from a valuation standpoint. But I'll pass that question off to you. I'd love to know what you think in that comment section below.